Imagine waking up tomorrow and seeing XDC trading on the NASDAQ with a ticker symbol, institutional investment banks underwriting the offering, and Wall Street analysts covering the stock with price targets. And I'm about to show you why this scenario isn't as impossible as you think and what it would mean for XDC's valuation. Welcome to Crypto Journal. Hit that like button if you want me to keep bringing you these thought experiment deep dives that explore scenarios nobody else is discussing. And don't forget to join the channel membership, where I'll be uploading exclusive institutional analysis and Wall Street coverage scenarios. You'll see the join button right next to subscribe. After understanding what an XDC public listing would mean, you'll want access to every update on this possibility. We're in November 2025, and XDC Network has quietly built everything traditional Wall Street looks for in a publicly traded company. Real revenue from enterprise clients, partnerships with regulated institutions, compliance infrastructure, a proven business model, audited financials, and most importantly, a clear path to profitability. Stick around because at the 19-minute mark, I'm going to break down the exact valuation multiple Wall Street would apply to XDC and what the stock price could be on day one of trading. Let me start by explaining why XDC going public isn't as far-fetched as it sounds. Because once you understand the precedent and the infrastructure XDC has built, you'll see this could actually happen. On April 14th, 2021, Coinbase Global went public via a direct listing on NASDAQ under the ticker CON. The cryptocurrency exchange opened at $381 per share, giving it an initial valuation of $99.6 billion. $99.6 billion for a crypto company. Let that sink in. Coinbase wasn't even a blockchain. They were an exchange for trading cryptocurrencies. Yet Wall Street institutional investors valued them at nearly $100 billion on day one. Why? Because Coinbase had real users, real revenue, real profits, and regulatory compliance. In Q1 2021, Coinbase reported $1.8 billion in revenue. That's more than they made in all of 2020. They had 56 million verified users across 100 countries. They were processing $223 billion in assets on their platform. And critically, they were compliant with US regulations, working directly with the SEC, FINCN, and state money transmitter regulators. Wall Street doesn't invest in speculative white papers. They invest in proven businesses with auditable financials and regulatory clarity. Coinbase had that. And guess what? So does XDC Network. XDC isn't just a blockchain protocol. XDC is Xinfin, a Singapore-based enterprise blockchain company founded in 2017 by Ritesh Kukkad and Atul Kakade. Xinfin is a registered business entity with corporate structure, employees, partnerships, and revenue streams. They're not a decentralized, anonymous developer team. They're a real company that could file for an IPO just like Coinbase did. And here's the critical difference. Coinbase is an intermediary. They make money by charging fees on crypto trades. XDC is infrastructure. They're building the rails for the $5 trillion trade finance industry and the $30 trillion tokenized real-world asset market. If Wall Street valued a crypto exchange at $100 billion, what would they value the infrastructure powering institutional trade finance? Come an IPO possible if you're starting to see how this could actually happen. Now let me walk you through what the IPO process would look like for XDC, because understanding the mechanics shows this is feasible. Step 1, corporate structure. XDC would need to ensure Xinfin is structured as a Delaware C corporation or equivalent. Most US public companies are Delaware C Corp because of favorable corporate law. If Xinfin is currently a Singapore entity, they'd likely create a US holding company structure similar to what many international companies do when listing on US exchanges. Step 2, financial audits. XDC would need to prepare audited financial statements covering at least 3 years of operations. This includes revenue, expenses, assets, liabilities, and cash flows. They'd hire a Big Four accounting firm like Deloitte, PwC, Ernst & Young, or KPMG to conduct the audit and certify the financials meet generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS. This isn't trivial, but XDC has the advantage of being an enterprise-focused blockchain. They likely already maintain detailed financial records for their institutional partnerships. Unlike purely decentralized protocols, XDC operates through a registered business entity that can produce traditional financial statements. Step 3. S1 registration. XDC would file an S1 registration statement with the SEC. This document discloses everything about the business: company history, business model, risk factors, financial statements, management team, use of proceeds from the offering, and more. The S1 becomes public, and the SEC reviews it to ensure adequate disclosure. This process typically takes 3 to 6 months. The SEC will ask questions, request amendments, and ensure all material information is disclosed to potential investors. Once the SEC declares the S1 effective, the company can proceed with the offering. Step 4. Underwriter selection. XDC would select investment banks to underwrite the offering. Based on Coinbase IPO, likely candidates would include Goldman Sachs, JP Morgan, Citi, Morgan Stanley, and technology-focused banks like Cowen or Needham. The underwriters help determine offering price, market the stock to institutional investors through a roadshow, and stabilize trading after the listing. Underwriters charge fees, typically 3 to 7% of the total amount raised. For a large IPO, this could be $50 to $100 million in banking fees. But the value is access to institutional capital and Wall Street research coverage. Step 5. Roadshow and pricing. XDC executives would embark on a roadshow, presenting to institutional investors like pension funds, mutual funds, hedge funds, and sovereign wealth funds. They'd pitch the trade finance opportunity, demonstrate traction with enterprise clients, show financial projections, and explain the competitive moat. Based on investor demand, the underwriters would set an offering price. This is where valuation gets determined. They'd look at comparable companies, apply revenue or earnings multiples, and gauge what institutional investors are willing to pay. The goal is to price the offering so it rises on day one, creating positive momentum, but not so low that the company leaves money on the table. Step 6. NASDAQ or NYSE listing. XDC would choose between NASDAQ and the New York Stock Exchange. NASDAQ is traditionally more tech-focused. Coinbase chose NASDAQ. Most blockchain and crypto-related companies would likely follow. XDC would select a ticker symbol. Let's imagine XDCN for XDC Network. On listing day, the stock begins trading. Existing shareholders can sell shares. New investors can buy. The market determines the price through supply and demand. If demand exceeds supply, the stock pops. If supply exceeds demand, it could trade below the offering price. But with institutional interest and retail crypto investors, XDC would likely see significant first-day demand. Step 7. Ongoing compliance. Once public, XDC must comply with all public company requirements: quarterly earnings reports, annual 10-K filings, SEC disclosure rules, Sarbanes-Oxley internal controls, investor relations. This creates overhead and costs, but it also provides legitimacy, access to capital markets, and liquidity for employees and early investors. The entire process from decision to list to trading on NASDAQ typically takes 12 to 18 months. XDC could realistically be a public company by late 2026 or 2027 if they started the process now. If you're still watching, comment NASDAQ XDCN. I want to see who's visualizing this scenario. Now let me show you how Wall Street would value XDC in an IPO scenario, because understanding the comparable company analysis reveals what XDC's market cap could be. Investment banks use several valuation methodologies: revenue multiples, earnings multiples, discounted cash flow models, and precedent transactions. For a blockchain infrastructure company like XDC, revenue multiples are most relevant since the company is likely not yet massively profitable, but is generating revenue. Let's look at Coinbase as the primary comparable. Coinbase went public at a $99.6 billion valuation with $1.3 billion in 2020 revenue. That's a 76x revenue multiple. Insanely high. But this was during peak crypto mania in April 2021 when Bitcoin was at $63,000. By late 2021, Coinbase stock had fallen significantly as crypto prices crashed. The valuation multiple contracted. As of November 2025, Coinbase trades at approximately $250 per share with a market cap around $60 billion. Their annual revenue is approximately $3 billion. That's a 20x revenue multiple. still elevated but more rational than the IPO valuation. Now let's consider other financial technology comparables. Square, now Block, trades at approximately 10 to 15x revenue, depending on the period. PayPal trades at approximately 8 to 12x revenue. Robinhood trades at approximately 15 to 20x revenue. These are established fintech companies with proven business models, but slower growth than crypto infrastructure. 4 high-growth B2B software companies, which is closer to XDC's model since they serve enterprises. Multiples range from 10 to 30x revenue, depending on growth rate and margins. Companies growing revenue 50% plus annually can command 25 to 30x multiples. Companies growing 20 to 30% command 15 to 20x multiples. Where does XDC fit? XDC generates revenue from several streams. Validator masternode staking rewards go to node operators, but XDC Foundation and Xinfin, the company, generate revenue from enterprise partnerships, consulting services, RWA tokenization platform fees, and licensing their blockchain infrastructure. Exact revenue figures aren't public since XDC isn't a public company, but we can estimate based on partnerships and activity. If XDC is processing trade finance transactions through Contour, tokenizing real-world assets, and licensing infrastructure to enterprises, they could be generating $10 to $50 million in annual revenue currently. That's an estimate, but reasonable given the scale of partnerships with institutions like HSBC, Citi, and Standard Chartered through the Contour platform. If Wall Street applies a 20x revenue multiple, common for high-growth fintech infrastructure, and XDC has $30 million in revenue, that's a $600 million valuation. If they apply a 30x multiple due to high growth potential in the $30 trillion RWA market, that's a $900 million valuation. XDC's current market cap as a cryptocurrency is approximately $866 million at a price of $0.049 per token. So interestingly, the public market valuation might not be dramatically different from the current crypto market valuation, at least initially. But here's where it gets interesting. Once XDC is public, Wall Street analysts cover the stock. Institutional money managers can buy it in traditional brokerage accounts. Pension funds and endowments that can invest in crypto can now gain exposure through XDC stock. This brings a massive new pool of capital. The total crypto market cap is approximately $2 trillion. The total US stock market cap is approximately $50 trillion. If even a tiny fraction of traditional equity capital flows into XDC stock, the valuation could expand significantly beyond what's possible in the crypto-only market. Additionally, being public provides M&A currency. XDC could use stock to acquire other companies, as Coinbase has done. They could raise additional capital through secondary offerings. They could offer stock-based compensation to attract top talent. All of this is challenging or impossible as a pure crypto protocol. Conservative scenario. XDC goes public at a $1 billion valuation, 20x revenue on 50 million annual revenue. Stock opens at $10 per share with 100 million shares outstanding. Within 12 months, as institutional coverage begins and RWA adoption accelerates, the stock trades up to $15 to $20. Market cap reaches $1.5 to $2 billion. Early public investors make 50 to 100% returns. Base case scenario, XDC goes public at a $2 billion valuation, 25x revenue on 80 million annual revenue. Stock opens at $20 per share with 100 million shares outstanding. Within 12 months, as enterprise trade finance deals materialize and XDC captures market share in the $5 trillion trade finance industry, the stock trades to $35 to $50. Market cap reaches $3.5 to $5 billion. Early public investors double to 2.5x their money. Bull case scenario, XDC goes public at a $3 billion valuation during favorable market conditions. Stock opens at $30 per share. Within 12 months, major announcements like bank integrations, government adoption, or a breakthrough RWA tokenization deal push the stock to $75 to $100. Market cap reaches $7.5 to $10 billion. Early public investors 3x to 3.3x their capital. These aren't fantasy projections. Coinbase stock went from $250 reference price to $429 on day one, a 71% pop. If XDC captures institutional and retail demand on IPO day, similar moves are possible. And if they execute on the trade finance opportunity, the stock could appreciate significantly over the following years as revenue scales. Now let me address how an XDC IPO would impact the XDC token, because this is the question token holders care about most. There are several possible scenarios for how Xinfin structures the relationship between the public company stock and the XDC token. Scenario 1, separation model. Xinfin, the company goes public as a separate entity from the XDC network. The company owns a treasury of XDC tokens and generates revenue by providing enterprise services, consulting, and infrastructure built on the XDC blockchain. In this model, XDC tokens continue trading on crypto exchanges independently. The stock trades on NASDAQ independently. They're separate assets, but related. The stock price reflects the valuation of Xinfin, the company. The token price reflects the demand for using the XDC network. Think of this like if Amazon Web Services went public separately from Amazon. AWS stock would reflect the cloud business value. But if AWS had a native token for paying for cloud services, that token would trade separately based on usage demand. In this scenario, an XDC stock IPO could be bullish for XDC tokens because it brings attention and legitimacy to the ecosystem. Institutional investors who buy the stock might also buy the token for exposure to network usage growth. Retail investors following the IPO discover XDC tokens and buy them on crypto exchanges. Increased awareness drives demand for both assets. Scenario 2, conversion model. Xinfin structures the IPO such that XDC token holders can convert tokens into stock at a predetermined ratio. This creates a path for token holders to gain liquidity through traditional stock markets. The company might offer something like 10,000 XDC tokens convert to 1 share of stock. Token holders can choose to hold tokens for utility or convert to stock for traditional equity exposure. This model is complex and would require significant regulatory approval. The SEC would scrutinize whether tokens should have been securities all along if they're convertible to stock. But if structured properly, it could provide an elegant solution that rewards early token holders while transitioning to a traditional corporate structure. Scenario 3, dual-class structure. Xinfin creates a dual-class share structure where XDC tokens effectively become Class B shares with different rights than Class A common stock sold in the IPO. This is highly unconventional and might face regulatory challenges, but it would directly tie token value to stock value. Scenario 4, buyback model. Xinfin announces that a percentage of stock IPO proceeds will be used to buy XDC tokens from the open market. Let's say they raise $200 million in the IPO and commit to using $50 million to buy and burn XDC tokens or hold them in treasury. This creates immediate demand for XDC tokens and signals alignment between the company's success and token value. Most likely scenario, separation model with treasury holdings. Xinfin goes public as a company that holds a treasury of XDC tokens, similar to how MicroStrategy holds Bitcoin. The company generates revenue from enterprise services and consulting. As the company succeeds and stock price rises, it brings attention to XDC tokens. The company can also use its balance sheet to buy more XDC tokens if they want to increase exposure. Token holders benefit indirectly through increased ecosystem awareness, institutional legitimacy, and potential company buybacks. But tokens and stock trade as separate assets, giving investors choice in how they want exposure to the XDC ecosystem. Comment token and stock synergy if you're seeing how both assets could coexist and drive value for each other. Now let me show you the regulatory pathway that makes an XDC IPO feasible, because understanding how XDC would navigate securities law is critical. The big question is whether XDC tokens are securities. If they are, the IPO process becomes complicated because the company is already distributing unregistered securities. The SEC could block the IPO or require remediation. But here's why XDC is well positioned. XDC tokens likely pass the Howey test for not being securities. The Howey test, established by the Supreme Court, defines a security as an investment of money in a common enterprise with expectation of profits derived from the efforts of others. XDC tokens are utility tokens. They're required for paying transaction fees on the XDC network. Node operators stake 10 million XDC to run masternodes and earn staking rewards. Enterprises use XDC tokens for gas fees when executing smart contracts. The tokens have functional utility beyond just investment. This is different from tokens sold purely as investments with no utility. XDC Network is sufficiently decentralized. Over 100 masternodes operated by independent entities globally. No single party controls the network. This decentralization supports the argument that tokens aren't securities because success doesn't depend on a central promoter's efforts. Additionally, XDC has focused on enterprise and institutional use cases, not retail speculation. Their marketing emphasizes trade finance infrastructure, not get-rich-quick token pumps. This positioning helps demonstrate utility focus, not security characteristics. If the SEC challenges XDC's token status, Xinfin could argue the tokens are commodities similar to Bitcoin or Ethereum, both of which the SEC has acknowledged are not securities. Alternatively, Xinfin could structure the IPO such that the stock represents equity in the company, while tokens remain separate network utility assets. The company disclaims any obligation to token holders beyond network maintenance. This separation could satisfy the SEC that the company isn't selling unregistered securities, just utility tokens for a decentralized network they help maintain. Precedent exists. Ripple has fought the SEC for years over whether XRP is a security. In July 2023, a judge ruled that XRP sold on secondary markets is not a security. This creates favorable precedent for other utility tokens. Ripple settled with the SEC in August 2025 for $125 million. The case is resolved. XRP can move forward. If Ripple can settle and move on, XDC can too. The regulatory environment in November 2025 is more favorable than 2021 when Coinbase went public. The GNIUS Act passed in July 2025, establishing clear stablecoin regulations. Congress is working on comprehensive crypto legislation. The SEC under new leadership is more crypto-friendly. This environment makes an XDC IPO more feasible than it would have been 3 years ago. Xinfin could proactively engage with the SEC before filing the S1. Request a no-action letter clarifying that tokens are utilities, not securities. Work with SEC staff to structure the offering in compliance. This collaborative approach reduces risk of regulatory roadblocks. Now let me compare XDC to other crypto projects that could go public, because seeing the competitive landscape shows XDC's advantages. Ripple and XRP. Ripple is a company. XRP is the token. Ripple could absolutely go public. In fact, Ripple's CEO Brad Garlinghouse has hinted at IPO possibilities once regulatory clarity exists. If Ripple went public, it would likely command a valuation in the tens of billions given their dominance in cross-border payments and partnerships with hundreds of banks. XDC and Ripple both targeting institutional finance makes them comparable. But XDC focuses on trade finance, while Ripple focuses on remittances and FX. Stellar Development Foundation and XLM. Stellar is run by a nonprofit foundation, which complicates going public. Nonprofits don't have shareholders or equity, but the foundation could create a for-profit subsidiary that goes public, similar to how Mozilla Corporation is a for-profit subsidiary of Mozilla Foundation. If Stellar pursued this path, they'd be comparable to XDC as an ISO 20022 compliant institutional blockchain. Algorand and ALGO. Algorand Foundation is also nonprofit, but Algorand Inc. could go public. Algorand targets institutional use cases like CBDCs and asset tokenization. They'd be direct competitors to XDC in the RWA space. An Algorand IPO would likely value the company at $1 to $3 billion based on partnerships and technology. Hedera Hashgraph and HBAR. Hedera is governed by a council of major corporations including Google, Boeing, and IBM. The governance structure is already corporate-friendly. Hedera Governing Council could structure an IPO, potentially commanding a valuation of $2 to $5 billion given enterprise adoption and council member prestige. Comparing these, XDC has advantages. Focus on trade finance, a $5 trillion market larger than remittances. Ownership of Contour, institutional-grade trade finance platform with proven traction. Partnerships with Tier 1 banks through Contour, ISO 20022 compliance, and SWIFT integration readiness. Singapore-based entity with international reach, not just US-focused. XDC might not have Ripple's brand recognition or header as corporate counsel, but they have a clearer path to revenue through trade finance digitization. Wall Street values revenue and clear markets. XDC has both. Let me walk through the timeline of what an XDC IPO could realistically look like if they decided to pursue this path today. Month 0, decision to pursue IPO. Xinfin leadership decides to explore going public. They engage investment banks for preliminary discussions. Banks assess financials, market conditions, and feasibility. If greenlit, formal process begins. Months 1 to 3, preparation phase. Xinfin hires Big Four accounting firm for financial audit, retains law firms specializing in securities and IPOs, begins drafting S1 registration statement, cleans up corporate structure if needed, establishes independent board of directors with public company experience, creates audit committee and compensation committee required for public companies. Months 4 to 6, SEC filing and review. Xinfin files draft S1 with SEC. Document includes full business description, risk factors, financial statements, management discussion and analysis, use of proceeds, and more. SEC reviews and issues comment letter with questions and required changes. Xinfin responds with amendments. Iterative process continues until SEC is satisfied. Months 7 to 9, roadshow preparation. SEC declares S1 effective. Xinfin finalizes underwriting syndicate led by Goldman Sachs or similar, prepares investor presentation, and begins roadshow. Management team travels to meet institutional investors in New York, Boston, San Francisco, London, Singapore, and other financial centers. Gauges investor interest and price sensitivity. Months 10 to 12, pricing and listing. Based on roadshow feedback, underwriters set offering price. Let's say $20 per share, 10 million shares offered, raising $200 million. Price is announced evening before listing. Next morning, stock begins trading on NASDAQ under ticker XDCN. First day trading is volatile, but closes up 30% at $26. Market cap reaches $2.6 billion. Post-IPO, Xinfin operates as public company. Quarterly earnings calls, annual shareholder meetings, institutional research coverage from Goldman Sachs, Morgan Stanley, Cowen, and others. Stock becomes eligible for index inclusion if market cap and liquidity meet thresholds. Over following years, stock price tracks company execution, trade finance adoption, and broader market sentiment toward blockchain infrastructure. This 12-month timeline is realistic. Some IPOs happen faster, some slower. But if XDC started today, they could be trading publicly by Q4 2026. Now let me address the potential downsides and risks of XDC going public, because not everything about being a public company is positive. First, regulatory burden. Public companies face extensive reporting requirements. Quarterly 10QS, annual 10KS, Sarbanes-Oxley compliance, audits, investor relations. This creates significant overhead costs, often millions of dollars annually. For a relatively small company, these costs are burdensome. Second, disclosure requirements. Everything becomes public. Financials, salaries, partnerships, risks. Competitors can see exactly what XDC is doing and copy strategies. Privacy is lost. Additionally, if financials disappoint Wall Street expectations, the stock can get hammered. Private companies can focus on long-term building without quarterly pressure. Public companies face constant scrutiny. Third, shareholder lawsuits. Public companies get sued constantly. If stock drops after an earnings miss, class action lawyers file lawsuits alleging securities fraud. Even if lawsuits are meritless, defending them costs money and management time. This is a painful reality of being public. Fourth, takeover vulnerability. Once public, XDC becomes vulnerable to hostile takeovers. If stock trades at a discount to intrinsic value, an acquirer could buy controlling stake and force a merger or acquisition XDC management might not want. Private companies control their destiny. Public companies are subject to shareholder votes. Fifth, short sellers, and market manipulation. Once XDC stock trades publicly, short sellers can bet against it. If they publish negative research or spread FUD, stock can crater even if fundamentals are strong. Market manipulation is harder to combat as a public company because you can't control who trades your stock. And sixth, misaligned incentives. Public company management often focuses on short-term stock price rather than long-term vision. Quarterly earnings become the priority. Innovation might suffer if it doesn't produce immediate revenue. This is the critique of public markets generally. XDC might be better served remaining private and focused on long-term trade finance disruption rather than appeasing Wall Street quarterly. My assessment: going public has pros and cons. The main benefits are access to capital, liquidity for early investors and employees, institutional legitimacy, and mainstream awareness. The main downsides are regulatory burden, loss of privacy, quarterly pressure, and potential misaligned incentives. Whether XDC should go public depends on their capital needs and strategic goals. If they can achieve their mission staying private, that might be optimal. If they need hundreds of millions for aggressive expansion and M&A, going public makes sense. Let me bring this all together with my take on whether XDC will actually go public and what it would mean for the ecosystem. Likelihood of XDC going public in next 3 years? I'd estimate 30 to 40% chance. It's definitely possible. Xinfin has the corporate structure and partnerships to support an IPO. The regulatory environment is improving. Precedent exists with Coinbase. The trade finance opportunity is massive enough to justify public market valuation. But there are also reasons XDC might stay private. The crypto market provides liquidity for tokens. XDC can raise capital through token sales or private venture rounds. Going public creates obligations and scrutiny that might not align with their decentralized network vision. And if tokenized RWA markets explode, XDC tokens could appreciate enough that an IPO becomes unnecessary. Token holders already have liquidity through exchanges. If XDC does go public, I'd expect it to happen between 2026 and 2028. That gives time for regulatory clarity to solidify, for contra acquisition to mature and show revenue traction, and for RWA tokenization to reach critical mass. By then, Wall Street will be more comfortable valuing blockchain infrastructure companies. Multiple precedents will exist beyond just Coinbase. Institutional appetite for crypto exposure through traditional stocks will have grown. What would it mean for XDC tokens if the company goes public? Short term, massively bullish. The IPO announcement would create awareness. Institutional investors researching the stock would discover XDC tokens. Retail following the IPO would buy tokens on Binance, Coinbase, or Kraken. Token price would likely rally 20 to 50% on IPO announcement and another pop on listing day. Medium term, sustained elevation. Having a publicly traded stock provides legitimacy. Media coverage of the stock brings attention to the ecosystem. Analysts covering XDCN stock mention XDC tokens in research reports. This creates sustained awareness that keeps token demand elevated above where it would be otherwise. Long term, depends on execution. If Xinfin successfully scales trade finance through Contour, tokenizes trillions in RWAs, and becomes the infrastructure standard for institutional blockchain adoption, both stock and tokens could see massive appreciation. Stock could 10x from IPO price over 5 years. Tokens could 5 to 10x as network usage scales. If execution disappoints, stock and tokens could both languish or decline. Public company scrutiny could expose weaknesses that are currently hidden. For token holders, an XDC IPO is a net positive scenario. It brings capital, attention, and legitimacy. The downside risks are mostly for the company itself dealing with public company burdens, not for token holders who simply benefit from increased awareness. Even if the stock performs poorly post-IPO, tokens trade independently on their own supply-demand dynamics. This is Crypto Journal, and I want to leave you with this thought. The future of blockchain isn't just decentralized protocols. It's hybrid models where companies and tokens coexist, where institutional capital flows through traditional equity markets and crypto markets simultaneously, where Wall Street and crypto bros collaborate rather than compete. XDC going public would be a watershed moment for that hybrid future. It would prove that blockchain companies can thrive in both worlds. and it would pave the way for dozens of other crypto companies to follow. Whether XDC pursues this path or not, the fact that it's possible shows how far the industry has come. From cypherpunk origins to NASDAQ listings, from trustless networks to corporate structures, the evolution is happening. And understanding scenarios like this gives you the edge to position accordingly. If you found value in this Wall Street IPO thought experiment, smash that like button. This type of analysis requires deep understanding of both traditional finance and crypto markets. Your engagement helps me reach more people who want this level of depth. Join the channel membership for exclusive content where I'll be tracking XDC's corporate developments, potential IPO signals, and institutional adoption milestones. The join button is right there next to subscribe. After understanding the IPO scenario, you know why tracking these signals matters. Drop a comment telling me, do you think XDC should go public on Wall Street? Or should they stay private and focus on token ecosystem? Would you invest in XDC in stock if it traded on NASDAQ? I read every comment, and your perspectives shape future content. Subscribe if you haven't already, because as the institutional blockchain landscape evolves and more crypto companies explore public listings, I'll be covering every development that bridges traditional and decentralized finance. The line between crypto and Wall Street is blurring. XDC might be the company that erases it completely. See you in the next one.